Imagine dedicating your entire life to understanding the financial markets. Like you spend decades building this flawless 17-year track record managing a hedge fund.
A literal lifetime of work.
Exactly. And it's 1998, right? The dot-com bubble is just inflating rapidly all around you. Companies with literally zero revenue and just a dot-com suffix are seeing their valuations explode.
Oh yeah, just massive, unprecedented numbers.
Right. So you look at the underlying fundamentals, you run your quantitative models, and you conclude with absolute mathematical certainty that tech stocks are massively, unsustainably overvalued.
Because they were. I mean, the math was clear.
The math was completely clear. So you make the only logical choice a fiduciary can make, really. You refuse to buy them, you completely avoid the bubble, you maintain a perfectly rational portfolio while the rest of the market just loses its collective mind.
And your reward for that perfect rationality.
Yeah, what's your reward?
Your investors just abandon you in droves.
Yeah.
Because, your short-term returns aren't matching the manic highs of the NASDAQ.
Right, they're looking at their neighbors getting rich.
Exactly. Your clients are furious that their neighbors are getting rich on paper while they are merely preserving capital. So by the year 2000, right before the entire tech sector collapses and proves you were right all along.
The ultimate vindication.
Right. But your hedge fund is completely dissolved by then. You lose your business not because your math was wrong, but because you underestimated the sheer gravitational force of human irrationality.
And see, to the listener, that story that isn't a hypothetical, it is a documented case study of a real hedge fund manager. And it perfectly encapsulates the terrifying reality of what we are analyzing today.
It really is terrifying when you dig into it.
It is. Because we FMPs, financial market participants, we operate under this collective delusion that financial markets are governed by cold, hard logic.
Like a machine.
Right. We assume that if you have the right data, the right spreadsheet, the right valuation models, the market will behave efficiently. But the moment you introduce real human beings into that system, the mathematical models just fracture.
They fall apart completely.
Because the human brain in the financial markets is basically an outdated operating system trying to run like ultra-modern software. It's not a supercomputer. It's an aggregate reflection of millions of psychological glitches.
Yeah, traditional economic models, specifically the ones rooted in the efficient market hypothesis,
Yeah.
they rely on this foundational axiom that humans act as homo economicus, right?
The perfectly rational human, which is a myth.
A total myth. The models assume that you, me, every institutional trader out there, that we process all available information instantly, without any bias, and execute decisions that strictly maximize financial utility.
Which is incredibly elegant on paper.
It makes the math work beautifully. But behavioral finance, which is the discipline we are really unpacking today, demonstrates with empirical certainty that we absolutely do not act that way.
So welcome to the deep dive. Today we are going through a specific, highly detailed learning module on behavioral finance and market behavior, specifically focusing on the behavioral biases of FMPs, or financial market participants.
And the goal here is to map out the exact architecture of these mental glitches.
Right, exactly. Okay, let's unpack this. We need to understand the invisible mechanics, the failures of logic, and the hijackings of emotion that compel incredibly intelligent people to execute terrible financial decisions.
Because, as that hedge fund manager learned the hard way, you literally cannot navigate the market unless you understand the psychological distortions driving the capital.
Right. So to dismantle these distortions, we first have to understand how the module actually categorizes them. It draws a definitive line between two fundamentally different types of system failures.
Right, the cognitive errors and the emotional bias.
Exactly. And this distinction isn't just, academic taxonomy. It dictates the entirely different mechanisms we have to use to fix them. So let's define the parameters of that first category. If an FMP is suffering from a cognitive error, what is actually malfunctioning?
Well, a cognitive error is basically a structural flaw in information processing. It stems from basic statistical errors, memory faults, or flawed heuristic reasoning.
Like a calculation failure.
Exactly. The individual might have access to the correct data, but the internal algorithm they're using to process that data is just generating a statistically invalid conclusion. It's fundamentally a logic error.
Right. And because it's rooted in logic, the text says it is generally susceptible to moderation.
Moderation, yes. Meaning you can actively intervene and fix the algorithm.
So if an analyst is miscalculating a discounted cash flow model because they are, say, misapplying a specific variable. You can just show them the mathematical error.
Right. You present them with the correct statistical framework, and assuming they are rational enough to accept the math, they'll update their process. They moderate the bias.
It's like misreading your GPS. You realize the mistake, you recalculate the route.
Perfect analogy. That is the defining characteristic of a cognitive error.
Mm.
It can often be mitigated through better education, better data visualization, or just more rigorous analytical frameworks.
But then we have the other side, the emotional biases.
Yeah, and these operate on a completely different neurological substrate. They don't stem from a miscalculation of probabilities.
Yeah.
They stem from impulse, deep-seated intuition, and, well, limbic system responses.
Fear, greed, pride, regret.
Exactly. Which means showing them a spreadsheet doesn't do a single thing.
Right, because if I'm holding a massive concentrated position in a collapsing stock just because I'm terrified of realizing a loss, walking me through the statistical probability of further decline won't suddenly cure my fear.
The calculation isn't the problem. The emotional regulation is the problem.
And that is why the framework suggests we cannot simply moderate emotional biases. We often have to adapt to them.
Adapting meaning you acknowledge the immutability of the emotional response and you just structure your financial environment to bypass it entirely.
You don't try to start feeling the fear of a market correction. You just build guardrails.
Exactly. You adapt by establishing rigid, rules-based asset allocation strategies that automatically rebalance your portfolio. You physically remove the decision-making power from your own emotional state.
Now, I want to challenge the rigidity of that binary, though.
Go for it.
It sounds like cognitive errors are just us being bad at math, while emotional biases are us being humans. But the idea that every terrible financial decision neatly falls into either a bad math bucket or a bad feelings bucket seems, I don't know, overly sanitized.
How so?
Well, if I'm holding on to a losing stock, I might be mathematically miscalculating its future cash flows while simultaneously feeling the emotional pain of admitting defeat. The bias is compound. It's like cognitive error is misreading the GPS, but emotional bias is getting road rage because of it. If a bias has elements of both, how do we even know which tool to use?
That's a very valid point, and the analytical framework actually accommodates that complexity.
Yeah.
It acknowledges that most irrational decisions are this hybridized web of both cognitive and emotional failures.
Okay.
But for the purpose of structural intervention, one primary root cause typically dominates. You have to isolate the prime mover of the irrationality to deploy the correct countermeasure. Because if you apply a cognitive solution like providing more historical data to a primarily emotional bias like regret aversion, you will only provide the investor with more raw material to rationalize their paralysis.
Oh, wow. So you just make them better at descending their bad feeling.
Precisely.
Okay, so it's the difference between a systemic hardware limitation and a localized software bug. Let's isolate the software bugs first. I want to drill down into the cognitive side.
Let's do it.
The module divides these cognitive errors into two distinct operational failures: belief perseverance and information processing biases.
Yes, and belief perseverance is particularly insidious because it deals with the friction of the human mind when confronted with new realities.
Which we all hate.
We despise it. It is defined as the inclination to maintain an existing belief despite encountering new, objectively contradictory information. The underlying psychological driver here is cognitive dissonance.
That severe mental discomfort you get when you're holding two conflicting schemas at the same time.
Right. The brain is actively trying to protect its prior assumptions to avoid the metabolic and psychological cost of restructuring its entire worldview.
And the module highlights conservatism bias as a prime example of this, right? Using the macroeconomic environment of Japan in the 1980s and 1990s as, like, the ultimate case study.
The Japanese asset price bubble is a textbook demonstration of conservatism bias operating on an institutional scale. Throughout the 1980s, Japan was the undisputed model of global economic growth.
And Nikkei was soaring.
Real estate valuations in Tokyo were astronomical, and the prevailing belief among global FMPs was that this parabolic growth was structural and permanent.
But then the underlying reality just shattered.
It burst. By 1990, the bubble popped. Growth decelerated rapidly, Asset prices collapsed, and the economic fundamentals shifted from explosive expansion to profound stagnation.
So the new data was glaringly obvious.
It was unavoidable. Yet the behavior of the analysts and market participants demonstrated a massive failure of what we call Bayesian updating.
Meaning they didn't update their probabilities based on the new evidence.
Exactly. In a rational market, as soon as that new GDP and corporate earnings data hit the terminals, forecasters should have immediately drastically revised their models downward.
They didn't?
No, they anchored to the historical reality of the 1980s. It took until the mid to late 1990s years of consistent, contradictory data before FMPs fully adapted their growth forecasts to the new, lower growth reality.
They just clung to their old views.
They exhibited conservatism bias by underweighting the new evidence and overweighting their prior beliefs. The cognitive friction was so high that they simply slowly dragged their models downward, bleeding capital the entire time.
That perfectly illustrates how a cognitive error isn't just a quick math mistake. It's a systemic failure to process reality in real time.
Yes.
Now, another subset of belief perseverance that fascinates me is representativeness, specifically the mechanism of the halo effect.
Oh, representativeness is huge. It's essentially base rate neglect. It occurs when market participants assess a complex probability based on a very small sample size or a superficial classification.
Like relying on simple stereotypes rather than rigorous statistical analysis?
Exactly. And the halo effect is probably the most dangerous manifestation of this in equity analysis.
The classic scenario here is evaluating a high-growth company, right? An analyst looks at a firm that has printed phenomenal revenue growth for, say, the last 8 quarters.
Which is one highly specific favorable characteristic.
Right. But instead of isolating that metric, the analyst's brain projects a halo over the entire entity.
The assumption becomes, well, if the past revenue growth is exceptional, then the management team must be visionary, the intellectual property must be impenetrable, the debt structure must be sound.
And most dangerously, the stock must be a fantastic future investment.
Exactly. They take a single heuristic shortcut and use it to completely bypass the agonizing work of actually analyzing the balance sheet or assessing market saturation.
They just classify the complex entity simply as good.
Yes, completely ignoring the nuance of risk.
And the illusion of safety derived from those shortcuts leads directly into the dual biases of illusion of control and confirmation bias, which the module links directly to the danger of under-diversified portfolios.
Concentrated positions are a massive red flag for these specific cognitive errors. And the most common iteration is the employee who holds the vast majority of their net worth in the stock of their own employer.
Which fundamentally violates modern portfolio theory. You are taking on massive idiosyncratic risk without any compensating expected return.
But from the employee's perspective, they feel insulated from that risk because they literally walk the halls of the building.
Right. They see the product shipping.
They feel an illusion of control over the macroeconomic forces acting on the stock simply because of their proximity to the micro operations of the firm.
I know the CEO, so the stock is safe.
Exactly. And once that highly concentrated, deeply irrational position is established, confirmation bias constructs a defensive perimeter around it.
Because their financial survival depends on it.
Right. Since the employee's net worth is entirely tied to that single stock, any negative news, like a delayed product launch, a poor earnings whisper, a macroeconomic headwind, it triggers immense cognitive dissonance.
And to resolve that dissonance, the investor actively filters out the negative data. They only consume research reports that validate the bullish thesis, and they just dismiss bearish indicators as noise.
The cognitive error perpetuates its own existence.
So those are the mechanisms of a stubborn mind refusing to update. But what about the other side of the cognitive divide? The information processing biases.
This is where the mind isn't necessarily protecting a deeply held belief. It is just fundamentally misusing the data presented to it.
Just doing the math wrong. And availability bias is the primary culprit here, isn't it?
It is. Availability bias is a heuristic failure where FMPs estimate the probability of an outcome based on how easily similar instances can be recalled from memory.
And the module provides a really funny, highly illustrative example of this with a character named June Park.
Yes, June Park, a CFA charter holder working at a prominent hedge fund.
Right. So Park is speaking at a networking event for recent university graduates, and he casually asserts to the crowd that most CFA charter holders work at hedge funds.
Which is statistically false.
Completely false.
The broad base of CFA charter holders are distributed across commercial banking, wealth management, asset management. Hedge funds represent a minority slice of that demographic.
So why does an individual who holds a charter that literally demands rigorous statistical competence make such a glaringly inaccurate probabilistic statement?
Because the heuristic bypasses the analytical training. When Park's brain attempts to answer the question, where do CFAs work?
Hmm.
It doesn't query a global database of employment statistics. It queries his immediate episodic memory,
Who are the CFAs he interacts with daily?
his colleagues at the hedge fund. Because that data is instantly available to his recall, his brain assumes it must be highly representative of the global population.
He extrapolates a hyperlocal data set into a universal macroeconomic reality. Now, I have to ask, is availability bias like June Park's just laziness, or is it a survival mechanism? It feels like we are hardwired to do this.
Oh, it is absolutely a deeply embedded evolutionary survival mechanism.
Mhm.
Think about it. If an early human sees a predator near a specific river, the brain doesn't need a peer-reviewed study on the migratory patterns of predators.
Right. The highly available, terrifying memory is enough to dictate the rule. Avoid that river.
Exactly. The problem arises when we apply that primitive, highly efficient heuristic architecture to the evaluation of complex, globally distributed financial data.
It's the wrong tool for the job. And perhaps the most mathematically destructive of these information processing errors is mental accounting.
Oh, mental accounting is fascinating. This is where the failure to process data logically destroys the mathematical optimization of an entire portfolio.
The module uses the case study of Esteban Kai, a 40-year-old surgeon, to demonstrate this. And his situation is wild.
It really is. So Esteban Kai has a massive income stream, $500,000 annually, and a heavily capitalized portfolio worth $4 million.
On paper, he has the resources to construct a highly optimized, resilient financial architecture.
But his internal accounting system is entirely fractured. He operates 4 distinct, fiercely segregated bank accounts.
Okay, let's break these down.
Sure. Account 1 receives his salary and is strictly earmarked for living expenses. Account 2 captures his annual bonus and is deployed solely for charitable donations.
Okay.
Account 3 sweeps the interest generated from his portfolio, which he rigidly locks away for retirement. And finally, Account 4 sweeps the dividend yield from the portfolio, which is exclusively used to fund his mother's living expenses.
If we connect this to the bigger picture, it's like the old envelope system for budgeting groceries and rent, right? But applied to millions of euros. It feels safe, it feels disciplined, but is actually blinding you to your total net worth.
Exactly. In the context of a multi-million euro wealth management strategy, it is a catastrophic cognitive error.
Mhm.
The fundamental flaw is that Esteban Kai is ignoring the absolute fungibility of capital.
Fungibility. A euro is a euro.
Exactly. A euro generated from an equity dividend is mathematically and economically identical to a euro generated from a surgical salary. But Kai's brain has drawn these artificial impregnable borders around these capital pools based purely on their origin and their intended destination.
Let's explain exactly why this destroys portfolio optimization. If we view this through the lens of modern portfolio theory, the goal is to construct an aggregate portfolio that maximizes expected return for a given level of risk, or minimizes risk for a given expected return.
Right, and you achieve that through the covariance of the assets combining asset classes that do not move in perfect lockstep.
But Kai cannot achieve that efficient frontier because he refuses to acknowledge the aggregate 4 million as a single portfolio. By isolating the accounts, he isolates the risk profiles.
Yes. Suppose the dividend account, which supports his mother, is heavily concentrated in high-yield equities to generate the necessary cash flow. That specific mental bucket is carrying massive equity risk. Meanwhile, his retirement account, relying only on interest, might be entirely in low-yield government bonds.
Because the accounts don't communicate, he cannot balance the aggregate risk. He might be inadvertently neutralizing his returns or taking on massive unseen correlation risks across the segregated buckets. He is analyzing the trees and ignoring the fact that the forest is on fire.
And the explicit solution provided in the text for moderating this specific bias is highly mechanical. A financial advisor must force Kai to aggregate all assets, liabilities, and cash flows onto a single, unified spreadsheet.
You literally have to force him to look at it as one big number.
You must systematically dismantle the imaginary mental borders by forcing the visual processing center of the brain to confront the holistic net worth. Only then can you begin to optimize the asset allocation based on aggregate risk tolerance, rather than the isolated emotional goals of each segregated bucket.
which perfectly transitions us from the failures of logic into the much darker territory of emotional hijackings. We've established that cognitive errors are processing failures we can moderate with unified spreadsheets and better data. But emotional biases are visceral reactions.
The feelings that hijack our wallets.
Exactly. These are the impulses that override the spreadsheet entirely.
And the module highlights several critical emotional biases that routinely devastate portfolio performance. Loss aversion, overconfidence, self-control, status quo, endowment, and regret aversion.
And what makes the analysis so compelling is how it demonstrates the intersection of these biases, right? How they cascade into one another to create total paralysis.
Yes, the interaction between endowment bias, regret aversion, and the status quo bias is a perfect example of this cascade.
Let's isolate those mechanisms.
So endowment bias is a psychological phenomenon where an individual assigns a higher value to an asset simply because they possess it.
Just because it's theirs.
Exactly. The ownership itself arbitrarily inflates the perceived worth. It is an irrational attachment.
Okay. And regret aversion.
Regret aversion, conversely, is a forward-looking paralysis. It is the intense fear that taking an action like selling a security or rebalancing a portfolio will result in a suboptimal outcome, leading to the acute emotional pain of regret.
So if you sell a stock and it immediately gaps up 20%, the mathematical loss of capital is compounded by the psychological agony of knowing you caused it. So investors naturally seek to avoid that pain.
Exactly. And when you combine the irrational attachment endowment with the paralyzing fear of regret aversion, the inevitable mathematical output is the status quo bias.
The investor does nothing.
They do nothing. They fail to execute necessary portfolio rebalancing, they hold on to deteriorating assets, and they refuse to adapt to shifting macroeconomic realities, simply because inertia is the path of least emotional resistance.
The inertia feels safe, even when the underlying asset is collapsing. So how does an advisor penetrate that paralysis? If we know we can't simply turn off the feeling of regret or attachment, what is the adaptive heuristic to force a decision?
The module suggests a really powerful reframing technique. When an investor is holding a stagnant or declining asset and cannot bring themselves to liquidate it, the advisor must force them to answer one specific question. If you had the equivalent amount of cash in your account today, instead of this security, would you buy this security at its current market price?
Oh, wow. That is a phenomenal psychological hack.
Right. It completely circumvents the endowment bias because it removes the concept of ownership from the evaluation. It forces the brain to analyze the asset as an external opportunity rather than an internal possession.
And if the honest answer is no, I would not deploy fresh capital into this asset, the logical dissonance becomes too loud to ignore.
It shatters the status quo bias by highlighting that holding an asset you wouldn't buy is mathematically identical to buying it again today.
That is such a practical takeaway for the listener right there. Look at your own portfolio. Are you holding on to a stock just because it feels like yours? But that addresses the paralysis of holding losers. I want to shift to the most destructive emotional loop associated with holding winners: overconfidence, driven specifically by self-attribution bias.
Ah, yes. This is where the neurochemistry of the market becomes highly relevant. The module details how this bias aggressively metastasizes during a rising macroeconomic cycle, a bull market.
Because in a prolonged bull market, the rising tide of liquidity and positive sentiment lifts almost all equities. An investor can throw a dart at a board of large-cap tech stocks and generate a positive return.
And that positive return creates a profound neurological event. Even if the investor executes a fundamentally flawed trade, maybe they bought a structurally weak company that was simply swept up in the sector momentum, the ultimate execution results in a realized profit. The transaction closes in the green.
And the brain immediately seeks to categorize the cause of that positive stimulus. This is the faulty learning model the text describes. Instead of rationally observing the macro environment and concluding, my profit is a beta-driven result of a massive exogenous market expansion, the investor internalizes the success.
They attribute the positive outcome entirely to their own intrinsic skill, their brilliant intuition, or their superior stock-picking acumen. That is self-attribution bias.
And the danger is what happens next. The dopamine hit from the perceived genius fuels extreme overconfidence.
The investor begins to deviate from their disciplined asset allocation. They increase their trading frequency, abandoning long-term strategies for short-term speculation. They severely underestimate downside risk, and they concentrate their capital to maximize the perceived alpha they believe they can generate.
They believe they possess an informational edge in an efficient market. The data on this is brutal, isn't it? The module points out that the mathematical reality for these highly active, overconfident traders is incredibly grim.
The empirical studies are unambiguous. The frictional costs of excessive trading commissions, bid-ask spreads, tax implications combined with the statistically poor timing of their entries and exits systematically degrade their performance.
So they actually lose out.
No, consistently. Overconfident, hyperactive traders consistently generate lower risk-adjusted returns than both the broader market indices and their less active peers, while simultaneously subjecting their portfolios to significantly higher volatility.
To combat this, the financial industry leans on the classic aphorism highlighted in the text. Don't confuse brains with a bull market.
A great saying. It's designed to mitigate that self-attribution bias, reminding investors that their success might just be exogenous market forces.
But here's where it gets really interesting. If selling for a gain confers a sense of pride, as the text says, aren't we basically fighting our own brain's reward system? How can any individual trader overcome the biological hit of dopamine from locking in a profit? You are asking someone to ignore their own biological reward system.
Which is why the most sophisticated institutional players don't rely on willpower. They rely on architecture. They understand that you cannot moderate the dopamine response. So they adapt by removing the human from the point of execution.
Algorithmic parameters.
Exactly. They utilize systematic algorithmic trading parameters. They set hard, predefined limits on position sizing and drawdown thresholds that execute automatically, completely bypassing the trader's emotional state. If you cannot trust the pilot because they are intoxicated by their own success, you have to engage the autopilot.
Which brings us to the most terrifying part of this analysis. We have examined how a single individual's portfolio can be dismantled by Estevan Kai's mental accounting, or June Park's availability heuristic, or the dopamine-fueled overconfidence of a day trader. But what happens when you scale those individual biases across the entire global financial system?
What happens when millions of investors suffer from the exact same emotional biases simultaneously?
Exactly.
The aggregate result is the catastrophic failure of market efficiency. You get the creation, inflation, and violent destruction of asset bubbles.
Market madness.
Yes. The module emphasizes that these aren't modern phenomena. They are intrinsic to human financial behavior. It points back to Charles Mackay's 1841 text, Extraordinary Popular Delusions and the Madness of Crowns.
Showing that the underlying hardware driving these events hasn't evolved in centuries.
Not at all. The module isolates specific modern iterations of this madness. The dot-com bubble of 1999 to 2000, and the global residential property boom leading up to 2008. The data presented on the UK housing market during that 2005 to 2007 period is staggering.
The specific metric highlighted is Exhibit 2, showing the UK average house price expressed as a multiple of average family income.
Historically, a sustainable housing market relies on a rational ratio between what an asset costs and the fundamental cash flow of the buyer. But during the peak of this bubble, that multiple expanded to an astonishing 6.5.
The average home costs 6.5 times the gross annual income of the average family purchasing it. Mathematically, given prevailing interest rates and living expenses, that debt burden is completely unsustainable. The underlying fundamentals screamed that it was an anomaly.
And yet, the capital continued to flow, inflating the bubble further. To understand why, the module maps the life cycle of a bubble directly onto the behavioral biases we've discussed. It is a compounding sequence of psychological failures.
Let's trace that sequence. Phase 1 is the ignition.
The ignition is always overconfidence and excessive trading, linked to confirmation and self-attribution bias. An asset class, whether it's internet equities or residential real estate, experiences a legitimate, fundamentally driven increase in value. Early investors realize massive profits.
Self-attribution bias takes hold.
They believe they have discovered a paradigm shift, a new economy. Their overconfidence drives aggressive leverage and excessive trading, pushing valuations beyond historical norms.
Then Phase 2 kicks in, which is driven entirely by the observers.
Exactly. The individuals who miss the initial expansion watch their peers generate seemingly effortless wealth. This triggers intense regret aversion. The psychological pain of missing out on the generational wealth-building event overrides their rational assessment of the inflated valuations.
FOMO, fear of missing out.
FOMO. To cure the pain of regret, they capitulate and deploy capital into the market at the absolute peak. This influx of dumb money is the final surge of the bubble.
But eventually, the laws of mathematics reassert themselves. The 6.5x multiple cannot be serviced. The The defaults begin. The earnings miss expectations. The bubble begins to unwind. But crucially, the market doesn't instantly snap back to intrinsic value, does it?
No, because of anchoring. As the asset prices begin to decline, the market participants anchor their expectations to the absolute peak valuations. If a stock drops 15% from its all-time high, they don't view it as a return to fundamental value. They view it as a discount from the anchored peak. They underreact to the negative structural data.
And as the losses accelerate, cognitive dissonance paralyzes the participants. They cannot reconcile their belief that they made a brilliant investment with the reality of their evaporating wealth.
So they rationalize. They blame short sellers, they blame the central banks, they filter out the negative macroeconomic data, they hold on to the collapsing assets, refusing to realize the loss until the financial pressure becomes absolute.
And that is the final phase, capitulation. The cognitive dissonance shatters, panic replaces overconfidence, and the mass liquidation event triggers the crash.
It is a perfectly choreographed psychological tragedy.
But the module introduces a concept here that completely reframes the narrative of a bubble. It suggests that participating in these massive myth pricings is not always driven by a failure of logic. Sometimes, participating in a bubble is a highly rational choice.
This explores the structural limitations of the market itself. The theoretical assumption of the efficient market hypothesis is that if an asset is fundamentally overvalued, rational arbitrageurs will immediately short sell the asset, driving the price back down to its intrinsic value.
But the real world has massive frictional costs, the limits of arbitrage.
Precisely. Shorting an asset during a parabolic bubble is incredibly dangerous. You have to borrow the asset, paying exorbitant borrow fees. You are subject to massive margin requirements. And fundamentally, your upside is capped at 100%, but your downside is mathematically infinite.
Right, because a stock can only go to zero, but it can rise infinitely.
Exactly. If the irrational madness of the crowd continues to push the price higher, the rational short seller will face margin calls and be forced to liquidate their position at a massive loss before the bubble ever pops.
As the famous quote goes, the market can remain irrational longer than you can remain solvent.
Right, and the text lists several reasons why rational FMPs ride the bubble. Lack of effective arbitrage, cost of short selling, unwillingness to bear extended losses, and the unavailability of suitable instruments.
But the most insidious driver of rational participation in a bubble is institutional career risk.
This brings us back to the story we opened with. The manager of hedge fund A versus the manager of hedge fund B during the dot-com bubble. Let's dissect example 16 from the text in detail.
It is the ultimate distillation of the principal agent problem in finance. The manager of hedge fund A looked at the tech bubble in December 1999 and explicitly recognized the overvaluation.
He knew it was a bubble.
He knew. He was quoted saying, "We thought it was the 8th inning and it was the 9th." But he rationalized maintaining his exposure. He believed he could time the exit perfectly, he assumed the momentum would carry the Nasdaq higher, and he underestimated the velocity of the collapse. Despite a strong 12-year record, he resigned in April 2000 after massive losses. Hubris destroyed him. But manager B is the chilling counter-narrative. Wait, so hedge fund B was right. They successfully avoided the cognitive errors, they stayed perfectly rational, and they lost their entire business because of it.
Yes.
Manager B executed perfect textbook rationality. He recognized the bubble in 1998, refused to deploy capital into fundamentally worthless tech equities, and avoided the cognitive errors of the herd.
And his reward.
Because he refused to participate in the madness, his fund underperformed the benchmark indices during the final, most explosive years of the bubble. His clients, suffering from massive regret aversion as they watched the rest of the market double, withdrew their capital. After a 17-year strong track record, his fund was dissolved in 2000, right before his rational thesis was entirely vindicated by the crash. This raises a huge issue about career risk. Are investment managers actually incentivized to act irrationally?
This raises an important question, yes. Investment managers accountable for short-term performance are forced to rationalize bubble participation purely due to commercial or career risk. The madness of crowds can financially destroy a rational individual. If they act rationally and miss the bubble, they suffer immediate commercial destruction. If they ride the bubble and it pops, they lose money. But they lose it alongside everyone else. They have conventional cover.
The gravity of the herd is absolute. And this gravity doesn't just create violent episodic bubbles, it also creates chronic, slow-burn anomalies in the market architecture itself. This leads us to the final, most heavily debated anomaly in modern finance, the historical performance divergence between value stocks and growth stocks.
Right, bubbles are explosive, but biases also create slow, chronic mispricing. To analyze this, we must rigorously define the parameters. In equity classification, value stocks are defined by low market valuations relative to their accounting fundamentals.
They typically exhibit low price to earnings, or PE ratios, high book to market equity ratios, and high dividend yields. These are often mature, boring companies or firms operating in distressed sectors.
They are structurally cheap. Growth stocks, conversely, are the high flyers. They have low book-to-market ratios, astronomical PE ratios, and low or non-existent dividend yields. The market is pricing in massive future earnings expansion, usually based on technological disruption or rapid market share acquisition. They are structurally expensive.
The traditional assumption under the capital asset pricing model, or APM, is that expected returns are strictly a function of market risk, or beta. But the module highlights the seminal 1998 study by Eugene Fama and Kenneth French.
The Fama French data is incredible. They analyzed 13 major global markets from 1975 to 1995, and the empirical data revealed a massive anomaly. Value stocks systematically outperformed growth stocks in 12 of those 13 markets over a two-decade period.
The cheap, boring, distressed companies generated consistently higher returns than the exciting, high-growth darlings. If the market is perfectly efficient, how does classical economics explain a two-decade anomaly of that magnitude?
Well, Fama and French, being staunch proponents of market efficiency, provided a rational mathematical explanation. They argued that the capital asset pricing model was simply incomplete. Beta alone couldn't explain the returns, so they expanded the architecture into a three-factor asset pricing model.
They added two new variables to explain the discrepancy.
Yes. In addition to general market risk, they introduced a size factor and a value factor. Their central argument was that the outperformance of value stocks is not an anomaly or a behavioral mispricing, it is simply a rational risk premium.
Because a company trading at a massive discount to its book value is likely facing severe operational headwinds, they have a greater potential to suffer distress during economic downturns.
Exactly. Value companies are inherently more susceptible to financial distress and bankruptcy risk. Therefore, rational FMPs demand a higher expected rate of return to compensate for taking on that elevated distress risk. The outperformance is just the math balancing the risk equation.
That is the elegant rationalist perspective. But the behavioral finance camp looks at the exact same data set and completely rejects the distress premium argument. They argue it is a structural mispricing driven by the halo effect.
The behavioral view fundamentally inverts the risk-return dynamic. When market participants analyze a growth stock, a company with a brilliant narrative, charismatic leadership, and a history of explosive revenue, the halo effect blinds them. They project the company's past operational success directly onto its future expected stock returns.
They equate a good company with a good investment.
And in doing so, they commit a massive cognitive error regarding risk correlation. They view these popular high-growth companies as inherently safe because of their prominent market position, but simultaneously expect them to generate massive market-beating returns. They emotionally assume a negative correlation between risk and return,
Which violates the bedrock principle of finance. The capital asset pricing model assumes higher expected returns require higher risk. But because the herd emotionally believes they can have both, they bid up the prices of growth stocks to levels that mathematically guarantee future underperformance relative to expectations.
Retail investors and even analysts get swept up in the popularity. The text notes that stocks of funds rated as popular in a Fortune magazine survey subsequently yield low returns. The anomaly isn't a distressed premium on value, it's a popularity penalty on growth.
So what does this all mean? It sounds like investors treat stocks the way we treat celebrities. We assume because someone is a great actor or a company has great past growth, they must also be a great person, have a great marriage, and be a great investment. We project safety onto popularity.
That is the halo effect in a nutshell. This emotional attraction is also enhanced by brand value, marketing, and the proximity of headquarters, which leads us to home bias.
FMPs consistently construct portfolios that overwhelmingly favor domestic or localized securities, willfully sacrificing the mathematical protection of global diversification. Why?
While FMPs often claim they have a perceived informational advantage, empirical studies show this is largely an illusion. The true drivers are psychological comfort from local access or a psychological desire to invest locally. Proximity breeds familiarity. It is an emotional preference masquerading as a strategic allocation.
And the final piece of this puzzle is momentum investing. The practice problems note that momentum is partly explained by availability and regret aversion, not home bias.
Right. Buying assets simply because they're going up. The rising price action dominates the financial media, making the upward trajectory the most highly available data point. And simultaneously, the acute pain of regret aversion, the FOMO on past winners, forces them to capitulate and buy into the trend.
It's unbelievable. We have journeyed from the deepest neurological impulses of the individual FMP to the macrostructural anomalies of global finance. We saw how a simple failure of Bayesian updating trapped analysts in the Japanese stagnation of the 1990s. We saw Esteban Kai's mental accounting, June Park's availability bias.
We examine the emotional hijackings, how the dopamine hit of a bull market fuels self-attribution and overconfidence.
Understanding these biases is the very first step in overcoming their effects on financial decisions. You can't fix a blind spot until you know it's there.
Exactly.
The ultimate imperative for anyone deploying capital in these markets is radical self-auditing. You have to interrogate your own thesis. Are you calculating risk, or are you seeking the dopamine of being right?
And even if you do achieve perfect rational clarity, the system itself presents a final existential challenge. Think about the manager of hedge fund B who was completely rational, correctly identified the tech bubble, and still had his fund dissolved after 17 years because his clients couldn't handle his short-term underperformance.
The man who saw the truth and lost everything.
It leaves you with a chilling thought to mull over. In a market driven entirely by the emotional biases of the herd, is choosing to be the lone rational actor actually the most irrational career move you can make?